Let's get more on today's sell-off, the technical aspect of it. Let's bring in the chart master, Carter Worth, to break it down. So, Carter, I guess the big question here is, has there been damage to the markets? Has there been damage done to the tech sector in particular?
Well, in many ways, yes. But I mean, conceptually, we're well past what analyst price targets are, competing with one another to raise those targets, the multiple for the market. That's long ago behind us. It's a function of momentum. And we know that whenever you have a fever, it's hard to know when it might break, but you know when you see a fever. It happens in auctions for art. It happens for Ferraris. It happens in the local corner where people are trying to overpay for houses, 20% above cash. When there's a frenzy, there's a frenzy. Now, they don't ring bells at the top, but you all referred to a lot of different chimes. The fact, one, that the VIX was not confirming. The fact that both Tesla and Apple split their stock as people are pouring in more and more. The fact that we were making all-time highs in the S&P and only 13% of the stocks in the S&P are making all-time highs. The average stock in the S&P is down 25% from its all-time highs. 50% of all stocks in the S&P have no gains for 2 years. These are all bells. In any event, let's look at some charts. So the first chart is just a one-year chart of the S&P 500, no judgments or annotations by me. Look at the second chart. Now, what we do know is if you do break out, if you will, move above a prior top, one reference point to use is the top from which you broke out. So we know that the January-February peak before the pandemic hit was 33.94 in the S&P, and the high today before this reversal, 35.88. So were we simply to drop back to that top, that's about a 5.5% sell-off, and we've come a good way already. We've done much of that. Take a look at the next chart. Now, drawdowns are normal. Since the March low, we've had three distinct givebacks. There was a 7.2% decline, which you can see there. A month or two later, a 6.4, and then an 8.3. We're due for that kind of thing. The question always is, and is the one that starts now, does that become a much bigger one? It's as good a bet as any, but the point is, as of now, it's perfectly normal. And then let's talk about tech. So here's a chart of the tech sector, the fourth of the 5 charts we're going to look at, and you can see a well-defined trend line. And the presumption is that we break trend. So the final chart, it's the same concept as the S&P. One reference point to use is the prior high from which you broke out. Now, were the tech sector to go all the way back to its January-February high, you're talking about a 20% decline. Just to sum it all up, I think it's important to say that, again, no one can know when a fever will break, but we know what a fever looks like. We know what a frenzy is as people bid more and more. It's not about valuation. It's nothing but that so-called Tina, there is no alternative, but that is not true. And Dan said it. The alternative is cash.
Carter, that's quite a bold call at this point. You're basically saying by looking at the charts, the alternative here is, in fact, cash?
Well, remember, see, it's the paradox of the investment community. It used to be that you were responsible for assets, and you had a certain amount in cash, a certain amount in bonds. You might do real estate or precious metals. We're so spliced and diced now that I'm only mid-cap TMT, and that's my mandate, so I can't hold cash. And that becomes a self-fulfilling thing, a portfolio manager that's so pegged and wedged into a spot. But the concept of stewardship of capital, of course cash, is an important part of that process.
Carter, thank you. Always great to get your insights. Carter Braxton Worth of Cornerstone Macro.